Most of the time when people put down their down payments like me, we get very excited and we tend to forget certain facts that can hamper or really help us down the line after we've put together this down payment. And those are the facts that I want to share with you in this video, just so that you don't get to a certain point in your house hunting journey and then you start to find out that things aren't all that they seem to be. So let's quickly get into it before I talk too much. My voice is cracking, excuse me.
A few moments later.
So number one, let's talk about your minimum down payment. So if your down payment is any bit of money that you have put together, saved up in your bank account, ready to be used to buy a house, then your minimum down payment is the smallest amount of money that you must have in your bank account before any bank or any lender would start taking you seriously. So let me explain. There are certain rules when it comes to down payments in Ontario, in Canada pretty much, and the first of which is if the price of the house that you want to buy is less than $500,000, then you have the ability to pay a down payment of 5%. So your minimum down payment on a house that is worth $500,000 or less has to be 5% before anyone starts to take you seriously. So, for example, you want to buy a $100,000 house. The least amount of money that you should have saved up to buy that $100,000 house should be 5% before a bank will even consider giving you a loan or a mortgage. Now, if the price of the house that you want to buy is between $500,000 and $999,999, then things start to get a bit tricky, but don't worry, everything will be explained. Be at peace. So let's assume that you want to buy a house that's worth $600,000. We're going to divide this $600,000 into two parts. The first part is the first $500,000 and the next part is the rest. So you take out $500,000 from $600,000 and you are allowed to pay at the very least 5% of that amount as a down payment. So what's 5% of $500,000? That's $25,000. Let's take that amount of money and keep it aside. Now we have the balance of $100,000 to go. You are allowed to pay at the very least 10% of that remainder figure, which is $100,000. And 10% of $100,000 is $10,000. So we take that money and keep it aside. When we look at it, 5% of $500,000 is $25K and 10% of $100,000 is $10K. Put those two figures together and you find out that the least amount of money that you should have ready to go when you want to buy a $600,000 house is $35,000. Pretty simple, pretty straightforward. Now, this is for the big boys and big girls out there. If the price of the house that you want to buy is $1 million and above, then you have to pay a flat 20%. There's no ifs, no buts, no coconuts or any types of fruits or vegetables involved in all those types of things. You just have to have your 20% down before anyone starts taking you seriously. Now, if you're looking to buy a second property, maybe you have a primary property that you're living in and you need a second property for investment purposes or for leisure purposes, then you're also going to have to get a 20% down payment as well. Now, not all down payments are created equal. So if you're paying anything less than 20%, then you're going to have to get something called mortgage loan insurance, which leads me to my next point. It's very simple. Number two, you're going to have to get mortgage loan insurance if you have a down payment that's less than 20%. And the idea behind mortgage loan insurance is quite straightforward. It all has to do with risks and how to balance them. So the bank normally doesn't want to take on much more than it should in terms of giving someone a loan. So let's use an example of a $100,000 house that you want to buy. Your minimum down payment is 5%, which is $5,000. And that means you're going to need your lender or your bank to loan you the rest of the $95,000. Now, if anything happens to that house, your lender or your bank is stuck with a $95,000 bill and they really won't know what to do with it except collect the house from you and see what they can do, sell it off and stuff like that. And you are only left with a bill of $5,000, which ideally it's not too much of an investment if you're just putting in 5% and someone else has 95% down. And this is where the bank starts to get uncomfortable, really, because they don't want a situation where they own too much of your house and you own too little and the risk is all on them and not enough risk is on you. Let's flip this example around. Let's say you have the $95,000 and you just need $5,000 of a mortgage from a bank. The bank will very easily give you that mortgage because, once again, they don't have too much skin in the game. You have more skin in the game, and if anything happens, they can pretty much walk away. They won't because they're a bank and they want their money, but you get the idea.
Pay me my money.
Well, I'm sure my people will be
In cash.
Now, if you've noticed the theme, the bank will get you to pay for mortgage loan insurance if they feel that they have too much skin in the game and you have too little skin in the game. So the whole reason for mortgage loan insurance is that if you default on paying your mortgage loan on time, or if anything happens to the house, they have someone, an insurance company ideally, to step in and say, hey bank, here's the rest of the money that this guy owes. Don't worry about it. You're safe. That's the whole reason behind mortgage loan insurance. And before I move on to number 3, it's very important to understand certain things. Mortgage loan insurance is much like your car insurance or your house insurance or any other type of insurance that you're paying. It doesn't go towards your down payment. It doesn't go towards anything that concerns the house apart from securing the banks behind in case you can't pay. Pretty much straightforward. You don't ever see that money again, and it's sad, but it's true. Now, having a 20% down payment might seem like a fantastic thing, and it is, but it doesn't necessarily guarantee you safety. And this brings me to number 3. You can be asked for a larger down payment. So normally you have 20% down, you're safe, everyone's singing Kumbaya, everyone's good to go. But if the bank looks at certain things in your profile and they don't really like it, they're going to want to, once again, remove the skin that they have in the game and have you put more on the line just so they can balance their risk. And I'll give you an example. 2 people walk into a bank. I know it sounds like a weird joke, but 2 people walk in a bank. One is Sarah, one is Fred. Sarah has all the boxes ticked for her. So she has a nice job that pays regularly, which is a huge thing. They want to see steady income. And she has 20% down and her credit is fantastic. These are the types of people that the bank wants to deal with because they pose the least amount of risk to the bank's ability to make money on the loan, and they reduce the possibility that the bank will lose money on a loan. So Fred walks in. He owns a Christmas shop, so he only sells stuff during Christmas. During the rest of the year, his income is spotty. He doesn't have fantastic credit either, but he also has a 20% down payment. The bank doesn't like working very much with Fred's types of persona because they pose a risk to their business. They don't want to give this person a loan and later find out that they can't pay. So they can ask Fred, they can tell Fred, hey, this 20% that you've brought, it's not enough. Please go back and bring an extra 20% and make it 40%. This way, everything else is easier for you to pay. You have less of an obligation when it comes to paying off your mortgage, and we have less of an obligation when it comes to not taking your house when you can't pay your mortgage, pretty much. It's harsh, but that's the reality of things. So if you, for one, don't have good credit, 2, don't have a steady income, the bank has the capacity to ask you for a larger down payment just so that they can shore up their risks and make sure that everyone is in a better position to manage their obligations when it comes to getting a mortgage. So let's move on to number 4. And we're going to keep number 4 very simple because depending on your situation, it can get very complicated. And number 4 just simply states that your down payments can and will be rejected if it's not coming from relevant or acceptable sources. So if you have $1 million stuffed under your mattress and you can't tell anyone where it came from, no one's going to want to touch that money because it might be the proceeds of money laundering or things that the bank can't get themselves involved with. Now, if your down payment came from stuff like your salary and you have the pay stubs to prove it, came from the bank of mom and dad, you got a gift from someone that's your immediate family, or you have dipped into your RRSP or TFSA, the whole idea is that you are able to prove that your down payment didn't come from the dark side. And once you're able to prove that, the bank will be able to get into discussions with you in terms of getting you the mortgage that you need to close your house. Just to recap, make sure that anywhere you get your money from, you have the receipts and you can let anyone know that that it's not from some kind of
plata or plomo.
Number 5, a bigger down payment can make things a lot easier for you. So we've spoken about the minimum down payments and all that fantastic stuff. When you start to edge towards your 35% down and higher, the bank starts to like you a bit more, because now you're making their job a lot easier. And because you're making their job a lot easier, that they will want to reward you for your hard work. They will give you, or they might give you, or they might start talking to you about lower interest rates, better mortgage rates, better payments on your mortgage, because you're not going to be paying as much as someone that paid a minimum down payment will be paying every month. They tend to start to like to dance with you and offer certain things to you that they would normally not offer anyone else. Just because you're bringing in more money, you're lowering their risk, and you're making things a lot more palatable for everyone. Now, these are 5 facts that I hope you've enjoyed, and I hope you can use as a checklist to make sure that you're on the right side of the down payment tango. And because down payments and mortgages go hand in hand, I'm also shooting a video about your mortgages, how to get the best mortgage for your situation. And I mean, we've had fun. Let me not take too much more of your time. See you in the next video. My name is Macaulay. I'm a realtor in Ontario, Canada. Very nice to meet you, and welcome to the channel.